Hello, folks. This is Dave Gilreath from Sheaff Brock Investment Advisors. Today is December 13th. Remember, Sheaff Brock is the firm that uses innovative portfolios for intelligent investors like you. So today we're going to talk about the end of the year 2021 and whether the Santa Claus rally will come or whether the Grinch is going to steal the punch bowl. Maybe what might happen next year, considering the Fed will probably be acting, and the fact that it is a midterm election year. So right now, it is the end of December, as I said. We're going to talk about the rally into year end. Next year might have a fair amount of volatility. We'll explain why. And the Fed may add to that as well. So the second half of the year, this is a chart of December that goes all the way back to 1950. And this just shows what the market does, where you can see it's reasonably flat in the first part of the month, goes down a little bit in the third or fourth trading day, back up and rallies, and then falls toward the middle of the month. And this is this year. We put that red box is so far this year through yesterday, the 12th, through Sunday, the 12th. And you can see, just like clockwork, the market went up in the first few days, went down into the third, fourth, fifth, and now has rallied back up to where we're at this little plateau. Wouldn't surprise us if we had a little bit of a sell-off this week, especially because the Fed meets on Tuesday and Wednesday, and that can always add a little bit of excitement to the market. But the end of December, the last half of December, has usually had a pretty nice rally, and it's gone up about 80% of the time into the end of the month. Now, the Fed, let's talk about the Fed. So the Fed, the press is going to get very excited when the Fed decides to raise interest rates and talk about how terrible that is for stocks. Well, in yellow, there is 6 months after the first Fed tightening, every time there's been a tightening, all the way back to 1983. And you can see that actually 6 months after the first Fed tightening, the market has actually done pretty well. It's only gone down once, but it's gone up an average of 6 or 7% in that 6 month period. So the first Fed tightening is not a reason to sell stocks. 2022 likely will be more volatile than this year for sure. But usually the midterm election year, which is the second year of a president's presidential cycle, they call it. Usually the second year is the most volatile. It has the biggest drawdowns. You can see here, negative 18.9 on average. However, the rally coming out of that drawdown is the strongest of all 4 years. So it usually is a more volatile year. Now, this is every midterm election year all the way back to, 1950. And you can see that every year, the red bar is going down. Every midterm election year, there has been a correction, every one. Now, some of them are small, 4% or so, 4 to 5. Some of them are pretty big. You can see 30%, 33%. So expect a correction. It most likely is going to happen. However, on the back end of that correction, the 12-month period following the correction has been terrific rebounds in the stock market. The average rebound has been 32%. So the average rebound has been almost 2 times what the average drawdown has been. And every rebound has been bigger with the exception of 1 year. So I think you might want to plan accordingly, that if there is a drawdown, maybe you want to add some more. History says that there should be a rally through the end of 2021. So Santa Claus should come to town. Volatility is likely going to increase in 2022. And there is a correction that's going to be likely next year. However, the recovery from it should be very, very good. Thanks for listening. Thanks for watching. We'll talk to you next year.